So everyone is totally fixated on big tech building smarter AI, but it turns out a massive chunk of the real money is flowing to the guys piping natural gas to actually keep the lights on. Welcome to Earnings Unscripted. It is April 22nd, 2026, and today we are unpacking Kinder Morgan, ticker KMI, and their Q1 results.
Right, because you cannot run a 150 gigawatt data center on pure optimism. You need physical infrastructure. And Kinder Morgan is literally the toll booth for that energy right now.
Exactly, which is a perfect time to remind everyone that we are just two friends talking markets, so this is definitely not financial advice. Please do not trade pipelines based on our banter. But seriously, looking at these numbers, revenue came in at $4.83 billion, which is up 14% year over year, and operating income was $1.44 billion. They had, nearly 30% margins?
29.9. Yeah, and adjusted earnings hit 48 cents a share, but you have to look at why that happened. This was not just steady, boring pipeline flow. The bulk of this outperformance was literally Mother Nature, handing them a massive premium. Winter Storm Fern froze everything, heating demand spiked, and their top 5 gas pipelines were running at well over 90% utilization. They were maxing out the grid.
So a brutal winter storm for the rest of us is basically a 36% jump in net income for them. That is the kind of natural hedge, I guess, you get when you move the fuel everyone desperately needs. But it was not just the weather, right? Did you see the thing with the Pasadena terminal?
Oh, the contract buyout. Yeah, that is actually a masterclass in squeezing yield out of steel tanks. Usually if a major oil tenant breaks a lease early, you take a hit. But their logistics team, just took the lump sum cancellation fee from the departing tenant in Q1, spun right around, and immediately leased those same tanks to completely different global players.
At higher rates, no less. So they got paid to empty the space and then paid more to refill it. That is honestly kind of hilarious.
It's extremely capital efficient, and the market is clearly rewarding that kind of execution. The stock had already rallied 22% over the quarter, and then today regular hours were flat, but once this printed, the tape spiked another 1.8%, and after hours to, I think it was 32.14. The buyers are definitely stepping in.
Okay, so strong tape, wild weather margins, and some really savvy leasing, but there's a lot more under the hood here. All right, let's get into the details.
Yeah, the weather and the tanks are great for a quick hit. But if you want to know what they are actually building, you have to look at the power grid. Or more specifically, how the AI boom is essentially bailing out natural gas.
Right, because tech companies love to talk about running on 100% renewable energy. But when you need power right this exact second, you kind of have to burn gas.
Exactly. The scale of it is just wild. Richard Kinder actually quoted an S&P report on the earnings call. He said, and this is a direct quote, "In a piece that surfaced just this week, S&P Global Market Intelligence reports that utilities plan to add the staggering number of 153 gigawatts of gas-fired generation capacity, primarily to serve data centers."
Wow, 153. I mean, that is just an enormous amount of power. And Kinder Morgan just added 3 new data center deals to their backlog, right?
They did. That pushed the total project backlog up to $10.1 billion. But what I actually find much more interesting than the new deals is what they are deliberately destroying.
Okay, wait, destroy. What do you mean by that?
Well, if you look at their crude and condensate volumes, they fell 12% year over year, which normally triggers a massive panic, right? The analysts would freak out. But they actually killed that volume on purpose.
Wait, so they turned away business?
Essentially, yes. They idled their Double H pipeline, just completely took it out of crude service so they could prep it to transport natural gas liquids instead.
Oh, that is brilliant. So they took a conscious hit on a top-level volume metric because the economics on the natural gas liquids are just that much better right now.
Yeah, precisely. It is a great example of how shrinking a specific KPI can actually be the ultimate flex of pricing power. They're just optimizing the chessboard based on where the margins are.
It's kind of like they're rotating their crops, but with hydrocarbons.
That is one way to put it, sure. And they actually have a huge cash windfall coming in to help fund all this repiping and transitioning.
Oh, the tax thing. I saw a note on that.
Right. So there was a new Treasury Department ruling in March. It basically lets Kinder fully capture bonus depreciation across all their assets. Their CFO, David Michaels, was saying this unlocks material near-term cash flow benefits. It basically bypasses the income statement and flows straight into their investment capacity.
Which they desperately need if they're going to keep building out these massive data center pipes. And they just bought the Monument pipeline for over $500 million, right?
$505 million, yes, expected to close in Q2. And that extra cash flow matters deeply because they're lugging around $31.8 billion in net debt. But even that is getting cheaper to carry. Moody's formally upgraded their unsecured credit to BA1 this March.
Oh, nice. So all three agencies have them solidly in that BB plus tier now, which reduces their refinancing costs.
Exactly. It creates this very nice positive feedback loop where the tax loophole funds the capex and the credit upgrade lowers the debt burden on the existing infrastructure.
It really is a masterclass in capital allocation. So they're flush with cash and perfectly positioned for the AI power surge. It almost sounds a little too easy. So where does this actually leave them heading into the rest of the year?
Well, they are actually sounding unusually confident. I mean, usually management gives you a very hedged outlook early in the year. But CFO David Michaels just flatly projected they will beat their original $8.6 billion adjusted EBITDA budget by over 3%. That is, it is basically $250 million in pure organic upside. And their leverage is dropping to 3.7 times.
Oof, which is the lowest since before their massive consolidation back in, 2014?
Yeah, exactly. But look, nothing is perfectly safe. Kim Dang even admitted, quote, "We have taken a somewhat conservative approach to our expectations." She is leaving the door open for upside, but they definitely know the risks.
Right. And let us just, acknowledge the global reality here. A lot of that potential upside comes from things falling apart everywhere else. The worse the shipping situation gets in the Red Sea, the more dependent our allies become on secure U.S. LNG, pushed through Kinder Morgan pipes.
Yeah, it is basically a massive geopolitical premium. But the internal risks are very real too. Investors are sort of ignoring the CO2 segment right now.
Oh, right. The Enhanced Oil Recovery Division.
Yes. Earnings there actually slipped year over year from 181 down to 168 million. That is the one unit with actual unhedged oil production exposure. If crude prices slump, that margin just evaporates. Plus, they have a revived $100 million lawsuit from Freeport over supply failures during Winter Storm Uri.
Wow. So Mother Nature giveth and taketh away.
Exactly. Litigation is basically the delayed cost of bad weather.
That's so cynical, but absolutely true. So I guess the short version is AI data centers need gas, and Kinder owns the pipes. Just, watch out for oil slumps and angry Texas lawyers.
That is the thesis. It is a highly profitable toll booth sitting on a few very localized fault lines.
Perfectly said. All right, we're going to leave it right there. Thanks for nerding out with us today, everyone. We'll see you after the next earnings call.
Thanks for listening.
If you want these earnings drops to just automatically show up in your feed, go ahead and follow the show. And just a transparent reminder that we do use AI to help research and voice these episodes, which is honestly the only way we can read through those massive financial filings so fast. If there is a specific company you want us to look at, just shoot an email over to earningsunscripted@datamadness.ca or catch the X link down in the show notes.
Have a good one.